Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for giving us a few minutes of your time. We've got quite a few topics to go through here. Show you a quick list here. We're going to talk about earnings. We're right in the middle of earnings season. We're going to take a look at the risk barometer, and then Andrew's going to hit a series of some technical points, including sentiment, the drawdowns that we've seen, and then seasonality. So we'll start off with earnings growth. So there's a lot of bars on this chart, including Europe, Japan, emerging markets. Just to keep things simple here, we're going to focus on the left and look at the U.S. What we're going to see is that in 2022, there was very little in the way of earnings growth. All right, of course, the market contracted. And then this year, we're adding to that with little growth at 1.8%. So all companies are just like you and I through those periods and struggling with higher costs. From here, the outlook turns brighter into 2024 and 2025 at 12 and 12.3%. That's what's reflected in today's environment. If you take a look at the consensus by the analysts who follow companies and you add all those up, that is the expectation. And I would say, I hate to put a negative spin on this. It's not really, but one concern certainly that we have to have is that a more optimistic scenario at this point in time is priced into S&P 500 stocks. Now, as Andrew has hit many times all year, and we've just hammered home, the S&P 500 is kind of a different beast because of how dominant the biggest players are. All right, so it's really, we have to separate in that there's two different S&Ps, one that is cap weighted and one that is equal weighted. And so I really don't think you're going to see as much optimism when you look at the average stuff. But one thing we've got our eye on is where that number is. And if for some reason the market begins to again expect a slowdown in the economy next year, I would expect those numbers to come down. So that's earnings. So far, so good in terms of this quarter's earnings. They've not been like lighting up the universe, but they are reflecting the fact that we are still growing as an economy and growing faster than one would have thought at the beginning of the year. Moving now to our risk barometer, which is one of the key tools that we use into our investment management process. It is an objective tool that we use that gives us an objective signal that we follow as it guides us to be on offense, on defense, or times in neutral. So this is a chart of the S&P 500, and each dot will reflect that offense, defense, or neutral posture. What we've seen so far this year has been a neutral reading. Now, there's different things that feed into the risk barometer. We want to do that so that we have not just diversification in the assets that you own in your portfolio, but diversification in terms of the inputs that we use. And so the two main sides to the risk barometer. On one side, we take a look at credit conditions. All right, when banks are healthy and banks are lending to businesses expand, then businesses hire, and that creates a positive feedback loop. That's just the easiest way to think about that side of it. And then the other side is the trends, the things Andrew fills you in each and every week. We just simply measure the trends in the market. Are they going up? Or are they going down? So this year we've had a split in that credit conditions have been tight all year, and that hasn't changed. We have been dealing with first banks just broadly pulling back, and then the crisis has only caused them to be a little bit tighter. So that side of the equation has been a more caution, but the trend of the market has been healthy. That changed last week. As you can see, we got the last dot on this chart over there is to the red. Now, just as how we use this to manage, this is not like my language is sports. So this is not like a football team where in today's world you've got 11 offensive players and you have 11 defensive players, and you're only going to be playing one side at any given time. When you go from offense to defense, boom, you switch over the whole field. Instead, this is a little bit more nuanced. And here we're going into next week, which is a beautiful season for those of us in Indiana. College basketball season is underway. So we think about this much more like a basketball team. You've got guys on the team, some of which are going to be both offensive and defensive players, but mostly you'll have some offensive specialists, guys that can knock down the three ball or play good in the paint. And you have guys who are defensive specialists. So what this tells us, we've been flagged to play more defense. So what we've got to do is bring those defensive specialists. We're not necessarily going to call a timeout and put them all in, and Andrew's going to share with you why. But we've got them at the end of the bench. We got them having their warm-ups off, and we are ready to put them in the game in more fuller form. But there are some reasons why we want to leave some of our shooters out there, because we do see some signs, again, that Andrew's going to fill us in, that they could have a good opening here or there. So that's the risk barometer. Andrew, why don't you fill us in on what some of those bright spots are and why we want to leave some of that offense on the court for at least now?
Yeah, thank you, Adam. I think that analogy really should resonate. At least it does for me with the comparison of the football team and basketball team. I think that's really well said. So hopefully you all that connects with you as well. So the past couple market curves that we've done, we've been self-admittedly probably not the most exciting, most positive comments that we've been able to share. Last week we were talking about the average stocks being down and a lot of sectors that were already negative. So we're very happy that we're able to share a little bit of more positive news this week, or at least I should say the foundations for what could turn into some more positive news. And it's actually a result of a lot of the negative things that have happened in the market so far. So we're going to kind of dive into a few different topics. We went into a lot of this in our allocation meeting, talking with our advisors. But the first thing we want to look at is the sentiment in the market and breadth. So sentiment's really important as it tells us, are people really, really bullish or really, really bearish? And that becomes critical when you're at very extreme points. We've found it historically when everyone is bullish and everyone is really gung-ho, the equity market, it kind of tells us there's not a lot of people left to buy, and that's when we start seeing some more rough waters in the market and stocks begin to turn lower. On the opposite side, when everyone's bearish and no one wants to buy stocks and everyone is fearful, those have been great times where we start seeing lows start coming to the market. At the same time, then we look at the breadth of the market. As always, the stock market truly is a market of individual stocks. When a lot of those stocks are going higher, that shows us it's a very healthy, broad participation by the individual stock market. But when we have a lot of stocks going negative, that tells us a lot of stocks are now in those downtrends, and that can help pull the indexes lower. So what we have today is we're in an environment where sentiment is very, very bearish. There's not a lot of people that are left bullish. As you can see on the middle part, the daily sentiment index is telling us there's only about 10% bullishness out there right now. And the bottom part's telling us a lot of stocks are in downtrends. So we have not a lot of people are interested in looking at equities, and a lot of stocks have really been declining quite a bit recently. Historically, that's provided a very interesting time and a much more attractive risk-reward type ratio, as we can see on the plotted green dots on the top panel. When we've had really low sentiment, a lot of stocks going down, that's been actually an opportunity where the market has had the potential to bounce and move higher. Now we're going to look something similar on this next chart. We'll get up on their screen, and that's going to look at the drawdown that we've seen. So at this point, the market is, as of Friday of last week, the market was down 10.28%. So we'll just call that 10% of a drawdown. And historically, when the market's had that type of drawdown after recently already being at a 52-week high, that's psychologically been very important. People view that the market is now offering a discount. Instead of trying to not be real excited about trying to buy those highs, they view it as it being 10% off. Similar if you went to the store and saw a price tag that said it was on sale for 10% off, they find that attractive. And historically, and that's why I plotted these blue dots on the chart, when we've seen the market decline by 10% from a recent 52-week high, we've often seen the market has tried to create a bounce. The caveat being obviously the great financial crisis, but a lot of the other times, we've actually seen the market has tried to get a recovery going after it's experienced a 10% drawdown, similar to where we're sitting today. Now, the next chart, and we're going through these pretty quick, and then we'll kind of summarize it at the end, is something we've talked a lot about for the last couple of months, and that's been seasonality. This market this year, and it's not always the case, but this year we've really seen the market track seasonal patterns very, very closely. August and September have been historically rough parts of seasonality, and we saw that play out in the U.S. equity market as well as stocks moved lower. October sees a lot of kind of whipsawing and ends with the market kind of seeing some weakness as well. Again, that's what we saw play out in the equity market this year as well. Now we start turning the page towards the year end, notably November, and that's where we start to see seasonal trends start to improve and they start to go higher. As you can see on this chart here, typically November, December, at least since 1970, have been positive months for the equity market. We see investors start coming back to equities, start pushing prices higher into year end after experiencing several months of these whipsawing top markets or markets going lower. And so now we've kind of set the stage for where there's not a lot of people that are bullish on the market. A lot of stocks have gone down. We've seen the market now go on sale by 10%, and we're going into a period that's been favorable for stocks. And that's why we think, or we're from the analysis that we're doing, is we think there's the opportunity. The foundation's kind of been set for maybe stocks to get a bounce. That doesn't necessarily mean we think things are going straight back to the prior highs from the summer, but we're looking for these different opportunities to where maybe the trend does start to firm up and maybe start to bend higher. And we're taking things day by day because we do recognize the data is suggesting that we're in this downturn, this downtrend. But we're seeing a lot of evidence that maybe that could reverse. And we're hopeful that that will continue to play out this week and as we move in to a fresh month with November.
Very, very well said, Andrew. This is quite a nuanced environment that we are in, and so thankful we got you in that seat to really be the man in charge of nuance. We're going to change your title to nuance manager. But to all of you, we do thank you for sticking with us and catching this market carver. As always, feel free to give us a call, 800-928-4001, if you'd like to set up a meeting and see if we might be able to help you out. And of course, as always, you can scan the QR code and do it digitally. So once again, thank you for your time.